Now, I feel that this particular article right here is extremely important. Now, Goldman Sachs no longer expects the Fed to hike rates in March, cites stress on banking system. Now, Goldman Sachs no longer sees a case for the Federal Reserve to deliver a rate hike at its next meeting, citing recent stress in the financial sector. Earlier Sunday, U.S. regulators announced measures to stem contagion fears following the collapse of Silicon Valley Bank. Regulators also closed Signature Bank, citing systemic risk. In the light of the stress in the banking system, we no longer expect the FOMC to deliver a rate hike at its next meeting on March 22nd, Goldman economist Jan Hazard said in a Sunday note. The firm had previously expected the Federal Reserve to hike rates by 25 basis points. Last month, the rate-setting FOMC boosted the federal funds rate by a quarter percentage point to a target range of 4.5% to 4.75%, the highest since October 2007. Now, Goldman Sachs economists said the package of relief measures announced Sunday stopped short of similar moves made during the 2008 financial crisis. The Treasury designated SVB and Signature as systemic risk, while the Fed created a new bank term funding program to backstop institutions hit by market instability following the SVB failure. Both of these steps are likely to increase confidence among depositors, though they stop short of an FDIC guarantee of uninsured accounts as it was implemented in 2008, they wrote. Given the actions announced today, we do not expect near-term actions in Congress to provide guarantees, the economist wrote, adding that they expect the latest measure to provide substantial liquidity to banks facing deposit outflows. Goldman Sachs added that they still expect to see 25 basis point hikes in May, June, and July, reiterating the terminal rate expectation of 5.25% to 5.5%. Now, the narrative in the market has changed a lot over the last week. Just 1 week ago, we were having discussions about the Fed potentially raising interest rates by 50 basis points next week because everybody was concerned about the inflation rate and how inflation was happening. So they felt that the Fed may go the extra mile to go from 25 basis points to 50 basis points. But we just got our inflation reading recently, and inflation was right in line with expectations, and it is showing that the rate of inflation is cooling down, even though it's not dropping like everybody wants it to. It is indeed still going down. So this is what I particularly feel. I believe that there is a possibility that the Fed may say, you know what, we're not going to hike rates at this next meeting, because this is what we have to pay attention to this next meeting. The Fed is not just going to tell us what the interest rates are going to be. The Fed is also going to give us a summary of economic projections at this meeting. They're going to tell us what they expect the unemployment rate to be, what they expect GDP to be, and what they actually expect the terminal rate to be, because the Fed has to give us that information. Now, the Fed, I feel like they are not going to just not raise interest rates by 25 basis points this time and then pick back up in May, June, and July. I believe that that would defeat the purpose, because a 25 basis point hike is not going to affect the stress that is already been caused in the system. We've already seen 2 banks fail. And so if, hypothetically speaking, or if theoretically the reason why these banks failed was because of the tightening due to the Federal Reserve, that means that these 25 basis points that they hold off of or that they give on is really not going to make a difference in terms of the entire banking sector. So if the Fed does not, so pretty much, let's just break it down to what I feel. If the Fed does not raise interest rates next week by 25 basis points or even 50 basis points, and they don't raise interest rates at all, I believe the Fed is going to be done, because for me, it doesn't really make sense for them to just not raise by 25 basis points this time and then raise in May, June, and July, because to me, that would show that they are panicking. They are panicking around what is going on, and the Fed does not want to panic. What they want to do is they want to ensure confidence. They want the American public to be confident in what they are doing. So I feel that they may raise by 25 basis points at this next meeting, but in regards to everything that has been going on, I believe that will give them a reason to pause, right? Because the Fed, they may not admit it to everybody else, but they may admit throughout the committee that, hey, y'all, we may have broken something in the economy. Something is going on with these particular banks, and this may provide a systemic risk. Because for me, I felt that if they were to raise by 50 basis points, the market will probably drop by 10%, because the market just would not be expecting a 50 basis point rate hike when they had already said that they were going to slow the pace of rate hikes, and they already came down to 25 basis points. I feel that 25 basis points would be a measured approach, because it's something that the market has already, it's something that the market is already expecting. You know, it's something that the Fed wants to do because they still care about inflation, but that would give them an opportunity to pause and say that, hey, we're going to monitor financial conditions here on out after we do the 25 basis point rate hike. Because if there is a bank contagion, and if something is actually going on in the economy, the Fed probably has a good idea about that. And they're not going to try to continue to tighten monetary conditions to make the bank system fail. Because at the end of the day, the Fed's responsibility and its mandate is to provide guidance on monetary policy, to provide guidance on monetary policy. So it's very, very important. And this particular FOMC meeting that Jerome Powell is going to have to lead may be the most important one that he has had in the last 12 months, because of SVB, because of Signature Bank, because of everything that we have going on with the inflation and all the things of that nature. He's going to have to field those questions, and he's going to have to answer those questions, and we're going to have to see how is he going to respond to that.